Welcome to the Common Sense Financial Podcast, a podcast all about finances, mindset, and personal growth. The goal? Helping you make smart choices with your money in your home and in your business. And now, your host, Brian Skrobonja.
Hello, everybody, and welcome to the Common Sense Financial Podcast. My name is Brian Skrobonja. I have been in the financial services business since 1993, and I've had actual face-to-face conversations with thousands of business owners, families, and individuals, helping them develop solutions for real-life situations. And it's my goal with this podcast to bring these real-life experiences to our audience and offer a way to think about these topics and how they actually apply to your situation. Today, we're going to be discussing the topic of mortgages. It is an area that many people seem confused and honestly often ask a lot of questions. And one of the biggest questions I get is, should I do a 15-year or a 30-year mortgage? And I'm just going to tell you right up front that I'm not going to discuss that specific topic today, since I've already covered this in length in other podcasts. If you missed that discussion, you can check out my podcast titled Busting Common Myths, and some of the others I did on cash flow, where we did talk about mortgages. Today, it's my goal to really help reduce the mystery around mortgages, and to do this, I've asked Brandon Smith to join us, who has been a great resource for me over the years, helping my clients with their mortgage needs. Brandon is the branch manager and senior loan officer for New American Funding out in Clayton, Missouri. I thought I would bring Brandon in to help us shed some light on some of the most frequently asked questions to help us out a little bit. Hey, Brandon, thanks for being here today. I really appreciate you taking time. I know you've been really busy with, doing mortgages and handling this hot real estate market and opening up an office out in Clayton and having a baby. You just got a lot going on. So I do appreciate you being here.
Absolutely. I appreciate you inviting me.
So today, just as I said in the intro, we're just going to be digging into mortgages today because we get tons of questions. Even though I don't do mortgages, that's why I have you. People ask me questions all the time when it comes to refinancing or buying a house or just needing to look at something to do with their mortgage, about the different fees and the different types of loans and how rates are calculated and all this. So I just thought it'd make a lot of sense to do a whole podcast on this and pull you in and try to get some answers for our audience. So I'm glad you're here. But I guess the best place to start would be talking about, the old school term of good faith estimate, which a lot of us who have done mortgages in the past know that that's a breakdown of fees. And with the Dodd-Frank rule, as you've explained it to me, is that it's now called a closing disclosure. So let's just start there, if you don't mind. Let's just talk through, what this simplification that went from 1 page to 4 pages, what these actual documents reveal and what we can expect to see on them.
Sure. With the Dodd-Frank they came out with, they'll send out a preliminary CD, which is essentially the old good faith estimate. Their intentions were good. The initial good faith estimate was very simple, itemized things, broke them down, much easier to follow. And they had the intention of making sure that everything was disclosed and the customer got a lot more information. However, it really just kind of tended to confuse. I'm personally hoping that they're going to do away with that and go back to something more like the good faith estimate. But the intention is the same. It's just the preliminary CD, good faith estimate, whatever you want to call it. We'll know what you're talking about. But that's just what initially goes out in the beginning to kind of give you an idea of what to expect.
Okay, so on that, though, this is a breakdown of fees, right? And it just explains all the little details about the fees. Let's just walk through those, if you don't mind, because everybody has questions about these, and they gloss over when they have to sign these documents or look at them. And so it's real important that they understand these, because those can sometimes even change from the time they start to the time the loans actually close. So being aware of what these fees are supposed to be, right, is probably a good idea. So just run through those fees for me.
Absolutely. Putting together a good faith or preliminary CD is a little bit more difficult than people tend to think. What we're doing are some of the things that you can expect. There's the lender portion of it. But when we're putting the whole thing together, we have to put together escrow accounts, title fees, appraisal fees, credit report fees, 4506 fees, which is the transcript of tax returns that the IRS charges us, requires us to order prior to closing. So there's a whole lot of things that go into this. And people tend to use the term closing cost. But it also includes your homeowner's insurance, like I mentioned before, your escrow account. These are prepaid items, things that I refer to help people understand better that that's your money. It's not an actual cost to do the loan. So when the preliminary CD goes out, we're estimating a lot of those things. We've got a pretty good idea of the closing cost because that doesn't vary a whole lot. I've heard a lot of people say that you can expect about 3% in closing cost. I think that's a very misleading comment, simply because if you're buying a $100,000 house, the cost to do the loan, for an appraisal, it costs the same whether you're doing a $100,000 or a $400,000 loan. The processing, the underwriting, credit reports, those things are all pretty much standard. Where you get into the variations is really in the taxes and insurance. Insurance is paid a year in advance at the closing, so a $100,000 home, probably looking at $700 or $800 upfront cost. $1 million home, maybe looking at a couple thousand or more. So those are things that are collected at closing that go into that lump sum, which people like to refer to as the closing cost, which is really what causes the variations. It's not necessarily the cost, it's more your prepaid items, because obviously on a larger home, your taxes are going to be significantly higher than on a smaller home.
So on that lender portion, as far as all the breakdown that you just went through, that includes the title insurance and all the little documents that go into that. Is that the case?
Correct. We're trying to estimate, especially on a purchase. We don't know the title company yet that they're using, or we don't have the fees from day one. We might know the title company and we have to order and get those, but those things will vary. Recording fees, that varies. The title company doesn't even know those until they get how many documents are going to have to be recorded and that sort of thing. So as the lender, we're initially putting together all of these estimations for you to try to give you as close to an estimate as we possibly can so that you know what to expect. There is something called a tolerance. There's a 10% tolerance on a lot of these fees that say that we can't, quote one thing that we kind of know what the cost is going to be and then significantly change it later, which I do think that is a good rule. I mean, back in the day, people used to say, I heard some lenders at some other companies make statements like the sale starts at the closing. I don't think you should be told your closing costs are going to be $2,000 and when you get to the closing they're $5,000. That's sort of deliberate as far as I'm concerned. But they're kind of pressuring you into sign, we'll get it done, we've done all this work, let's just move on. So there are some things that the Dodd-Frank did that were good to help protect borrowers.
So what kind of fee total, removed from the prepaids, the homeowners and the taxes, let's remove that from the equation because as you've explained, that's just their money. They're just having to funnel it through that closing document, right? So just on the lender portion and that quote unquote closing cost, what kind of costs are typical when it comes to that? Is it, $500, $1,000, $2,000, $3,000? How much should people expect and not have a sticker shock on that?
That's a great question, and it leads into a couple other things, but I'll touch on that first. Typically, you're looking at standard processing, underwriting, credit reports, 4506. Sometimes we have to order things like verifications of deposit from your bank that we get charged for a lot of these things. So I would say, generally speaking, on the lender side, you're looking at roughly $1,500, something like that. You've got an appraisal in there of $450. Those are things that we get charged for. Kind of jumping into another topic. That's not necessarily always the case. We are a direct Fannie Freddie lender. So what we do when we lock, there's usually, and I don't want to go into too much detail because it'll just kind of it can get confusing, but we also give lender credits. So once we get into the lock portion, there's something called a service release premium or something like back in the day, especially brokers get paid out the back end for locking that loan. That's one of those fees or things that I like to explain to people because they're always wondering, well, how are you getting paid? Where's it coming from? And that comes from the higher the rate you lock, the more money they would pay us to purchase the loan because it's more profitable on their end, obviously long term. So they'll make that money back and then some. What we do is we actually give that service release premium or that kickback, so to speak, back to the customer. So let's just say your closing costs are $1,500. Well, if I'm getting a $1,200 kickback, we give it to you. So now it's only $300. I've seen them anywhere from $100 to $3,000. So it varies based on your loan amount and your rate, the rate that you pick and that sort of thing. But
So I guess that could lead into why some companies say, hey, we can do the loan for free, we don't charge anything, where other people may be charging thousands of dollars, or where one person would go to one lender and it's a certain rate and they go to another lender, it's another rate. I mean, this all could be quite confusing. And so any light you can shine on that as to why there's such a rate variance, or maybe why the closing costs can vary so much, and how one lender can offer a no closing cost type of deal versus somebody else charging thousands of dollars?
Absolutely. That's a great question and a great topic. I hear that all the time on the radio. Close with us and you have no lender fees. We can pay your mortgage insurance. I've heard that. Things like that, it's always rolled in somewhere. Nothing's free. I mean, we go back to Grandma said, if it's too good to be true, it probably is. There's no lenders out there that are at 3%, another at 4%. It's just not like that. We're basically getting all the money from the same place. It's very, very close. You're paying those fees one way or another. We are getting billed for certain things. When I touched on that $1,500 we talked about earlier, those things have to be paid. So we have to make that money to cover it somewhere. Everybody does. So if you want no closing cost, well, then it's very simple. You raise the interest rate. We use those credits and we cover the closing cost. If we've all heard of points. If you want a really low interest rate, well, you still have those closing costs and you have to pay what it cost us to buy that lower interest rate. So it's just looking at those things and deciding which is best for you. One thing I would say is very misleading, or a little bit misleading, that gets on my nerves a little bit, is advertising these things and not kind of giving both sides of the story. It's really easy to advertise the good but not explain where it's coming from or how it's getting paid, because I assure you the customer's always paying it. It's got to come from somewhere, and one way or another the customer's paying it. It's just very important to explain all the different options and make sure that they're making an educated decision, as long as they have all the information to make that decision with.
So really it's just marketing. It's one lender to another, just what is their niche. They may be selling the lowest rate but charging a lot more money, where somebody else may be charging a little bit higher rate but are focusing on the fact that they don't charge any closing cost, or somewhere in between.
That's absolutely correct. The general public doesn't necessarily understand all of these things, which is, obviously I don't know what they do for a living nearly as well as they do. But it's real easy to advertise an interest rate on the radio because it gets people to call. That's what is generally known. I get the question all the time, what are the interest rates? Well, my response is, which interest rate do you want? Let's get into more detail and discuss which interest rate is best for you. The lowest interest rate is not always the best deal. And if you listen to the radio, a lot of times in the small talk at the end, they'll state it's almost always a 15-year FHA mortgage. Well, those come with fees. Those come with mortgage insurance. Even if you have 20% down on a 30-year mortgage on an FHA loan, it still has mortgage insurance. Mm-hmm. So if you have a 3% rate, but your mortgage insurance is crazy high, is that better than having a 4% rate? Not necessarily.
That may be a good segue into just kind of discussing the different types of loans, because you just mentioned an FHA loan, and then I know the other side of that, I guess, is a conventional loan, and then within those two categories are a lot of subcategories. So without going way overboard on that, maybe just help explain the difference between an FHA and a conventional, and maybe some of the nuances of different types of loans underneath those.
Sure, that's a great topic as well. Conventional, I would generally say, is more for your good credit, larger down payment, lower debt ratio type borrowers. A lot of people refer to FHA as first-time homebuyer's loan. That's not true. It's not a first-time homebuyer's loan. What it does is it gives a low interest rate. There's higher fees, but they kind of fit everybody into a box. It's more of a pass-fail type loan. So generally speaking, and this doesn't hold true in every scenario, but if you have an 800 credit score and 10% down, and you're really solid, you don't really want that first-time homebuyer's loan, as they tend to refer to it, or that FHA loan, because your interest rate, even though it might be slightly higher, your mortgage insurance is going to be significantly less. Your upfront fees are going to be significantly less. Now, conventional loans are scored more like auto insurance. So clearly, if you drive a Ferrari and you're 17 years old, your insurance is going to be significantly higher than if you're 50 with a clean driving record driving a Honda Civic. But FHA kind of puts everybody into that box, pass-fail. So you pretty much get the same interest rate, same mortgage insurance, that sort of thing. So if you do have a much lower score, lower down payments, and maybe not quite as qualified as an older person who maybe had more time to save and build more credit, then it is a great loan, because that interest rate on the conventional loan is going to go up. The mortgage insurance is going to go up for those scenarios. Whereas FHA, you're not going to get hit nearly as hard for them.
And so with underneath those, I guess you have adjustable rates, you have, fixed rates, you have, 15, 30. I mean, maybe get into some of that as well as the different types of loans under each different scenario.
Sure. I've been doing this 13 years, and I've done very, very few adjustable rate mortgages, even back in the heyday when everybody was selling them and telling you get this great rate, and then they come out 10 years later and say, hey, the same people that put you in that loan tell you, hey, you need to get out of that loan and get yourself into a 30-year. I think an adjustable rate mortgage is misunderstood. I think it's a great product. I actually had one myself at one point, as long as you understand how to use it. And that's the biggest thing, is educating yourself on what are you getting into, what are you using it, what's the benefits, what's the drawbacks. If you know you're going to be in a home for less than 5 or 7 years, why would you pay a premium interest rate to lock in a loan for 30 years? It makes sense to take a 5 or 7 year arm. I get it. 15-year, obviously, lower interest rate. It's going to save you interest over time, but you're going to have a much higher mortgage payment to pay it off in 15 years. It's very simple. Generally speaking, unless somebody just has a lot of extra money and $400, $500, $600 a month doesn't mean anything to them, and they're just set on wanting to pay off their mortgage, I generally refer them to a 30-year. Depending on rates, if there's not a huge gap between the 30-year and the 15-year, take the 30-year, have the peace of mind that you only have to make that lower payment if need be, and take the extra money and go ahead and pay it off as if you're going to pay it off in 15 years. It's really not going to cost you that much more.
Yeah, and that's a good point. And as I mentioned in the top of this podcast, I've done a couple of different podcasts on cash flow, and I've explained the math of a 15 and a 30. And what you just hit on is more in line with just having control over your money, having control over your cash flow. And so I think that's a good point to say that, if you're only tied to a 30-year payment versus a 15, you can still pay it off in 15. You can pay it off in 5 if you wanted to make the extra payment. So the amortization schedule that the mortgage company's giving you doesn't mean you got to follow that amortization. Exactly. Just going the 30-year gives you the flexibility. Correct. So I guess a couple other things here is that I get questions about, and sometimes you and I have these discussions as well, is what actually affects rates, and what should people be thinking about in terms of locking in a rate?
Boy, we could go on forever about this one. Generally speaking, once you can lock in on a 15-day lock, a 30-day lock, a 60-day, 90-day, all the way up to a year, maybe even more. I don't know. I've never done one. Anywhere close to a year. Personally, I think it's silly. I call it locking in losses, because the banks are required to set that money aside for you. The longer you lock in, the more expensive that rate becomes, or the more expensive the fees associated with that rate become, because they're required to take that money and set it aside for you for 30, 60, 90 days. What I like to do, unlike a lot of people in the industry, they'll say, lock them if you got them. You get the application, you get it in, you get a quote, and the person's okay with it, you lock it and you move on. I'm kind of cheap. I like to kind of play the game a little bit. So I know if we're locking on a 45-day lock or a 60-day or a 30, we're locking in losses, because as long as the market doesn't move up, then we're going to get a better deal if everything stays flat, if I can lock on a 30 or 15. So I look at it like this. Even if things get a little bit worse, I take that shorter lock and we're still in the same boat. If things stay flat, you end up getting a better deal, and if they get better, then we win on both sides. I follow the bond market a lot. That's more of a direct, you can see the bond market, the yields going up, interest rates going up, the yields going down, interest rates going down. Interest rates are obviously a huge topic with mortgages. I think it's overdone a bit. I think people tend to get too tied into interest rate. It might only cost you an extra $10 a month. It's not going to be life-changing. And don't get me wrong, I want to save you $10 a month or whatever we can. But I'd prefer to kind of play the game and see if I can save you some more money up front, or get you an extra $1,000 credit because we get better pricing.
So the bond market affects the rates, and then you kind of just more of a wait and see when it comes to actually locking in the rate.
Sure. If obviously if the bond market, the yield's moving up or something's going on in the economy, then you just pull the trigger. Yeah. Because if you feel like you're going to lose more than what you would gain, just lock it and call it a day. But if they're kind of staying flat, even if it ticks up a little bit, I'd rather ride the wave and see get the best deal that we possibly can.
A couple other things here is that, especially for a first-time home buyer, but even for people that are veterans to buying homes and buying cars, they still are a little bit fuzzy on how you actually qualify for a loan. So what are some of the things that the underwriters are looking for as far as qualification? I mean, obviously good credit is a good thing, but what about like ratios, income to debt ratios, and just what are some of the things that the underwriters are looking at to determine rate, to determine, what type of loan they can qualify for, or whether or not they can even get it?
That's a great question. That varies based on the type of loan that you're looking for. We touched on that FHA being more lenient to the first-time home buyer sort of generation that people tend to refer to the FHA as a first-time home buyer's loan. They'll go up to, I get them approved all the time in the mid-50s, upper 50, 57% range as far as a debt ratio. They'll take much lower credit scores, down to 580. Technically, they don't even have a credit score minimum. But generally speaking, you're not really going to get it through past a 580. But the four things they look at on all loans is credit, income, collateral, and reserves. And then based on the loan that you're trying to get into, those vary. You're looking at roughly 50% debt ratio on a conventional loan, up to 57 on a FHA loan. I've had VA loans go as high as 62, 63, 64%. Now, what is debt ratio? It's a very simple calculation. Let's say you make $5,000 a month. Once we add in your mortgage, your proposed mortgage payment, along with any car loans, student loans, anything that shows up on your credit report, let's just say those equal $2,500. Everything together, $2,500, total income $5,000, and that's gross, not net, so that's your gross income. That would be a 50% debt ratio. So again, credit, income, collateral, and reserves, credit history, it all just varies really based on the program that you're looking for. But the collateral, the amount that you're putting down, the reserves that you have in the account after closing, you might say, hey, I've got the $5,000 down payment, but I've got $5,007 in my checking account. Well, it's a little bit scary to an underwriter knowing that you're going to move in with $7 to your name. I mean, I'm pretty sure you're going to want to buy some new curtains for that house, or you're going to want to do something. And I certainly hope that nothing goes wrong with that house because now you own it. It's not a rental. So, reserves are one that people don't tend to put much stock in or think about much, but that definitely helps a file for sure.
Well, so obviously the down payment has a lot to do with the design of the mortgage and the payments, and from a budgetary standpoint, what people can afford and whatnot, trying to have that balance between the payment and how much money you're keeping back for your curtains, et cetera, right? So, but that ties in, I guess, to the idea of putting 20% down to be in that sweet spot, I guess, of not having what they call the mortgage insurance or the PMI insurance. So if somebody, the way I've always understood it anyway, is that if somebody puts down less than 20%, then the mortgage lender is going to want to insure that risk. So maybe talk a little bit about that and what people need to be aware of when it comes to PMI and, of course, defining it.
Sure. Ultimately, if you're not putting down 20% on a purchase, you're going to pay mortgage insurance one way or the other. Again, some of those radio ads and some of the things mentioned out there, the marketing pieces state, we'll cover your mortgage insurance. Well, all they're doing is raising the interest rate to the amount that covers the amount of mortgage insurance, and they're paying it. The lender takes on a certain, or I should say the servicer, takes on a certain responsibility for that loan. So Fannie Mae and Freddie Mac basically insure all the loans. But the lender takes on about 20% responsibility of that. So should the loan default, the lender's going to incur some costs for sure. And so the lender wants to insure that risk that they're taking on. So they're requiring you to pay for mortgage insurance to cover the part that they're responsible for. If you put down 5%, 10%, 15%, each tier, the mortgage insurance, the rate at what they're charging with mortgage insurance goes down. So it's very similar to your interest rate on a conventional loan. Like I mentioned, FHA is pretty much pass-fail. You're going to get the same interest rate, whether you're a 640 score or a 720. It's not that way with conventional. And mortgage insurance is the same with FHA. It's all the same risk factor. It's all the same calculation. But conventional is based on the credit score and the amount that you put down. So obviously the higher credit score and the more money you put down, the cheaper the mortgage insurance gets to cover that amount that you're not putting down.
One of the things that Brandon's on a lot of people's minds a lot of times is trying to get money out of their house. You know, they spend this time trying to buy their house, and they're paying down that mortgage, and they're hoping that that house is going to appreciate. But at different times throughout life, a lot of times it does make sense to try to tap into that equity for whatever reason, especially if it's for home improvements or something major to the house. What are some of the strategies people can use for actually getting some of that equity out of the house in a very cost-effective manner?
A couple different strategies. One, we can do a cash-out refinance. We can take up to 80% of the value of your house. FHA can go up to 85%, but I would say, kind of as a rule of thumb, stay around that 80%, 75% even. Make sure you're getting the best deal possible, because there is what we call hits to the rate and fees and stuff when you get up into that higher level. If that doesn't make sense, there is a home equity line of credit option. We do them, but we are not experts at them. Like I said, we are, very, very good at the residential first mortgage, servicing, all that Fannie Mae, Freddie Mac, everything out there except kind of the seconds. HELOC is a great option. It's something that I would say I will be happy to explain. It's fairly simple, but I think there's some things about it that tend to scare people. But I've got a HELOC on my house. I think it's a fantastic tool as long as you use it right. And it won't get you in much trouble. It's really is an excellent tool to use to go obtain some of that equity that you have sitting in your home that's not really doing much for you.
I've often explained it as kind of like a credit card on the house, where if you have a home equity line of credit, it's kind of that. It's a line of credit. So if somebody has a line of credit for $50,000, it doesn't mean necessarily, right, that they owe $50,000. It just means they can actually write checks or use up to $50,000. So it's kind of like that credit card, where if you have a credit line of $50,000 on a credit card, you're only paying interest on amounts you borrow, and you can pay it off and pay it down as your budget allows or as the project allows. Is that a correct explanation of that?
I'd say that's a pretty good breakdown of it. A simple breakdown is the kind of the credit card. I would look at it like that. It comes with a checkbook. People are like, well, I can write a check on my house. Yeah, you can write a check. Just because you take out a $50,000 or $100,000 line of credit, if you only borrow $2,000, you only pay interest on $2,000. Now I have to say, consult with your CPA about what I'm getting ready to say, but it is on your house, so it could be considered a tax-deductible expense as opposed to a credit card. Interest rates are typically in the 3%, 4%, maybe 5% range, as opposed to a credit card compounding at 10, 15, 20%. So it can be a very good tool for sure. The one thing that I touched on a little bit earlier is where people tend to get in trouble with it is, hey, I want a swimming pool. They go write a $50,000 check, and they don't want to pay any extra towards it. So they're just paying interest on this thing forever. It is an interest-only loan. You can pay it off. You can use $50,000 today and pay it off in 2 weeks or 2 years, whatever. But just understand that you're paying interest on the money that you borrow. So I always tell people, try to pay that down as much as you can, and it's really not going to hurt you.
Yeah, and I just want to be clear, is we're not, I guess, in this conversation, not encouraging consumption. What we're talking about primarily is if somebody's needing cash for an investment opportunity, or if somebody's needing cash to do home improvements and those types of things, with some explanation and some good planning, utilizing some of that equity could be a way to make those improvements in a very efficient manner, or have an investment opportunity outside of the house that could actually, yield you some gains. And so utilizing that equity could make a lot of sense.
That's exactly right. I think one of the big things that I failed to mention previously was we always need money. It's always hard to borrow money when we need it, right? You lost your job, something happens. Well, it's hard for me to get you a loan when you need it. If you've got $100,000 in equity, go take out a line of credit. Have it there as a safety net too. Even if whatever you plan on doing with it, but have it as a safety net. Even if you don't need it, have access to those funds just in case someday you do. It costs you nothing to have it there.
That's a great point. And the clients listening to this will know what I'm saying when I say this, that banks don't lend money to people who need it.
That's exactly right.
A couple other things from a standpoint of loans is that what if somebody's wanting to buy a second house, is that essentially just the same process of doing a first mortgage? Is the rules pretty much the same? What are some nuances there that may be different if somebody's looking at a second property?
They're very similar. In fact, there are some rules that qualify a property as a second property. I mean, it has to be a certain distance away. They don't want you buying a second property 4 doors down. They know what you're doing. You're going to make it an investment. But it has to be a certain distance away or in a community where there's fishing, golf, something like that, where it can, qualifies as a second home. People tend to think that it's kind of the investment type deal where you have to put down 20% and all that. It's not. I mean, you can get away with 5% down on a second home, just as if it's a primary residence.
So leading into what you just said, though, with investment properties, so we do have, several clients that are real estate investors, and some of the questions we get is with people that have multiple properties, and maybe they have one that's paid off, one that's mortgaged, and maybe have some expenses on one that they need to make. And so, as far as taking money out of a investment property or getting a loan on an investment property, are there a lot of differences between looking at a first mortgage on a residence or a second home versus an investment property? Is there a lot of differences there?
I would say it's in the same ballpark, but it's a totally different world. Your investment properties are scrutinized much more thoroughly. They want rent schedules. They want balance sheets in some situations. They want your P&Ls. They want to know, they want to know a lot more, and they're much more strict on what they're willing to lend. They look heavily, or they scrutinize much more heavily on investment and cash out. I would recommend, if you qualify and you're looking to take cash out, kind of stay at that 75% mark, because you go over 75%. I know 80's sort of the magic number, what everybody knows, but we call them hits to the rate. So you start out at one rate. Every, risk factor that we tack on, rates go up, fees go up, that sort of thing. So just as a general rule of thumb, if you've got a bunch of equity in a real estate property and you want to start playing with those numbers on your own, I would say you could play with that number of taking up to a loan of about 75% of what you think the value of that property is.
Okay, good stuff. So I guess to wrap up, let's just maybe for somebody that is getting ready to do a refinance or somebody that's getting ready to purchase a house, specifically on the mortgage side, what are some good practices there? I mean, we hear about pre-qualification letters. We hear about how much time they should give themselves to be able to even get a mortgage. What are some good rules of thumb, good practices for people getting into, buying a house, or I guess that would be the main one, is buying a house, of when they would want to get those pre-qualification letters, right?
Sure. Well, yeah, most people are interested in the house, right? That's the big, fancy, shiny object that we all love. We all love our home, and we all want to go shop for homes. Us lenders are kind of like the umpire. You don't really want to deal with us. You don't really want to hear from us. We're just kind of a part of the process that has to be there. I would definitely recommend on a purchase, call the lender right away. I've heard it so many times, oh, my credit's perfect. We don't need to run credit. I'm good. Don't worry about it. And then we go to pull it later, and they find out, well, they're maybe a car that their child didn't make the payment that they co-signed on, or something that I could have helped them fix. 3 months later, when you go to write that contract, we may have been able to help fix that and put you in a better loan because we knew up front. So even if you think you've got perfect credit and you're the perfect borrower, I'd love to talk to you, but I would recommend definitely calling and getting pre-approved up front, and then going out and looking at all those beautiful homes with your realtor. As far as a refinance, one thing I would say, contact somebody you trust, because I'll give you one example. I had somebody, a very large loan amount, $800 and something thousand. They had called 2 other lenders and was referred to me after they'd already talked to them. And you kind of hear this a lot. If you can't drop 1%, then it doesn't make sense. That just throw that out the window, one of those old wives' tales. Because, for example, if the loan is completely free, truly 100% free, and you're only saving $30 a month, isn't it a true savings of $30? But if the loan costs you thousands and thousands of dollars and you're saving 1%, you might not break even for 10 or 15 years. That loan doesn't make sense. So back to the guy that had called me, he got these quotes from a couple other people, and asked for a quote from me. And I gave it to him, and he said, well, that's great. That's an eighth lower than anybody else I talked to. How do we get started? And I said, well, let me ask you some further questions. How long have you been in the loan? Was one of the first questions I asked. He'd been in it 13 years. Well, even though we were saving him over 1% in interest, he was already 13 years into that amortization schedule. So dropping 1% in the interest, I was actually costing him $18 to $20 more a month in interest and starting him back over in the very beginning. So I told him, this doesn't make sense, don't do it. And he said, well, nobody else told me that. That's great. I appreciate it. And of course, that's how we try to conduct business. We hope it turns around. And sure enough, he sent me 2 of his friends to refinance later, and theirs did make sense, fortunately.
Yeah, just making sure we're taking care of clients and making sure we're doing what's best for them and helping them understand things, which is the whole idea about this, behind this podcast, is to help people think through these things. And so I appreciate you being here today, Brandon, and helping us think through mortgages and just understanding the details of the mortgage and how to view that disclosure document, and just kind of shed some light on some of this stuff, because this can be confusing and at times very intimidating for people. And so having people like you available to help our clients, we very much appreciate that. So thanks for your time today, Brandon.
Absolutely. Thanks for having me on. It was a pleasure.
If you have questions about what you heard about today, shoot me an email at yourmoney@sfgplan.com, and I will do my best to point you in the right direction. That concludes today's podcast. I am Brian Skrobonja. Thanks for listening to the Common Sense Financial Podcast.
Securities offered through Kalos Capital Incorporated and investment advisory services offered through Kalos Management Incorporated, located at 11525 Park Wood Circle, Alpharetta, Georgia 30005. Skrobonja Financial Group is not a subsidiary of Kalos Capital Incorporated, nor Kalos Management Incorporated. The opinions and views expressed here are for informational purposes only. This material is educational in nature and should not be deemed as a solicitation for any specific product or service. All investments involve risk and a potential loss of principal. Kalos Capital Incorporated nor Kalos Management Incorporated offer tax or legal advice. Please consult with a tax advisor or attorney for advice regarding the impact on your portfolio.